Follow the value, not the herd. No, that's not a Robert Frost poem. It's the title of our midyear 2025 Private Markets Outlook, published in late July alongside our new brand and new name, Future Standard. The Outlook not only takes stock of where markets stand more than halfway through 2025, it lays out our core thesis that we're entering a new era of private markets investing. Despite the incredible volatility present in policymaking, economic data, and the public markets, the first 7 months of the year were another gradual step forward for private capital markets. The number of private equity transactions completed rose 8% compared to 2024, while real estate investment volume improved by 13%. Although these numbers may seem pedestrian compared to the robust expectations coming into the year, they imply an impressive resilience in the face of serious market dislocations. Policy uncertainty, higher interest rates, and slower economic growth will likely keep the most rambunctious of animal spirits tamed for the foreseeable future. However, many of the conditions for a rebound in market activity, including ample capital, pent-up demand for deals, and solid fundamentals in many sectors, remain in place. Our outlook doesn't just analyze the cyclical rebound in deal activity. We spend the bulk of the report discussing how to invest into it. We see private markets being on the precipice of a new era. The period from 2010 to 2021 was dominated by unique dynamics brought about by ultra-low interest rates and ample liquidity. The past 3 years have been a transition period, with markets reacting to the most aggressive Fed hiking cycle in decades. Now we see the emergence of new trends beginning to shape and define this new era. First, fundraising across asset classes is increasingly concentrated within the largest managers and strategies. This raises competition for large deals and will likely make it more challenging for these managers to produce alpha. Second, we're in a durably higher interest rate environment. This means returns will be dictated less by leverage and valuation expansion and more by the operational performance at the asset level. Third, the era of placid globalization is over, ushering in a period of greater geopolitical competition and policy uncertainty. This creates new challenges, especially for globally oriented firms, but also introduces new opportunities. We believe that these are the three trends that will define the next era of private markets investing, and we're going to dive deeper into some of the research behind and implications of these views on this episode. And for that, I'm happy to welcome in our Executive Director of Investment Research and my esteemed podcast co-host, Andrew Korz.
Alan, how's it going?
Doing well. Thanks for being here today.
Thanks for having me.
So Andrew, we're here to discuss the private markets outlook, the mid-year 2025 outlook for our firm. This is really your vision. This is something that, we've worked on tirelessly over the past month and a half or so. And, I really wanted to ask to start off and just tee this discussion up, what was, your vision in terms of what you hope to accomplish with the outlook? And then if you could, just describe how it's laid out. I think it's very interesting, the structure, and, makes sense when you read through it. And it's got a common theme throughout.
Yeah, absolutely. And, I think sort of the goals for this piece are kind of twofold, right? So number one, I think our job in research is always to keep folks apprised of what's going on in the markets and specifically in private markets, which is kind of where most of our strategies lie. It's important, it's harder to get information on these markets relative to maybe the public stock market or public credit markets. So introducing some folks to the data that we watch is really important. But the second I think core part of why we wrote this piece is to introduce this idea of the new private markets imperative, right? Mm-hmm. As you so eloquently laid out, there's a lot changing in the world right now, and a lot of that is impacting not only public markets but private markets as well. So as we sort of enter this new cycle, this new era of sort of an investment landscape, we wanted to sort of look at some of these changes and how they apply across private equity, private credit, and real estate. And, I think as we go through this episode, and, this is going to be a series, so we'll go through each asset class individually. We're going to talk more in depth about those trends. But the way the piece is laid out is really, number one, we have, asset class specific outlooks for each of private equity, private credit, and real estate. And then we also have these overarching defining trends, right? The three trends that you just laid out that we're going to double click on today. And these really transcend single asset classes. They really are the fundamental sort of, tectonic shifts that we see occurring, right? And I think throughout the rest of this episode, we're going to pull them through into each of these asset classes and really, hopefully give investors some tangible, takeaways for how they can implement them in a portfolio.
No, I love the way that you put it. We really tend to try to focus on like what are the largest shifts that are occurring and then relating that down into actionable insights for our investors. And so when we think about where, the macro economy is today, we've had, some data that suggests that the economy is slowing a little bit. We've gone through a period, of the past several years, and especially post-COVID, a very resilient, robust strength. Consumers been very healthy. You saw household debt really deleverage and provide a boon to what's been a very resilient labor force, resilient consumer. Now, obviously, we've got the AI business capital expenditure megatrend underway. What is the sense of the lay of the land from the economy's perspective?
Yeah, so I think if you compare where the macro is today relative to call it January, things have changed a lot. There's no doubt about it. Coming into the year, the consensus was sort of 2 to 2.5% GDP growth.
Sure.
Maybe a slight slowdown from what was a really hot growth period in 23 and 24, but an expectation that growth was going to be strong again. It was going to be broad-based, but, from the consumer to businesses to, even the government. And what we've gotten was something very different, right? And I think two things have happened. Number one, you've had policy that's been implemented that's sort of broadly slowed growth,
sure.
Right? So you take tariffs, and we've seen consumers react to tariffs by maybe pulling back a bit, increasing their savings rate. Businesses have reacted to tariffs and the uncertainty around tariffs by maybe tabling some non-essential investments, and that's sort of slowed growth across economic sectors, right? And then you've got more specific pockets of the economy, like the housing market comes to mind, right? Where you've got prices falling in certain metros, residential investment is really weak right now. And then you've got, the government, right? You had DOGE and the federal government, but you've also got slower spending in state and local governments, which had actually been really important parts of the growth story over the past couple of years. So where does that leave us? We're in, call it a 1 to 1.5% type of growth period now, slower than the beginning of the year. This is not a recession. Base case is still not a recession, as you mentioned. Sure. Wealthy consumers still really well supported. They drive a lot of the consumption in the economy. The AI investment boom is alive and well. And the most important thing is the labor market still looks relatively healthy. Now we had, the poor jobs report last month. That's obviously something to watch. But, as we look at it today, I think the core tenets that keep the economy expanding remain in place.
Sure. And it never feels good when the economy slows, but this is something that we've forecasted for, the past, couple of quarters at this point, that this would be the trend of the economy. And, this is what it kind of feels like. There's a little bit of...
Doesn't feel good normally.
It doesn't feel great. And there's waning kind of optimism economically. You mentioned some of the uncertainty that you're seeing come through in the business data, but at the same time we see the stock market going on to set all-time highs. Price to earnings ratios of 25 times and greater at different points throughout the year. Recovering off of a trough around 20 times. Following Liberation Day, the rapid sell-off, but then the very rapid recovery. And although tariff policy has kind of settled more so at a place that is still very substantial relative to where we were, and very much changes the economic landscape. There will be many businesses that have to adjust. The market's just absorbed that in stride. So, what do you think is really, driving some of this, optimism in the public equity market? We're seeing the same thing in credit spreads. And, how do you explain this kind of back and forth that we're seeing?
It's pretty remarkable, right? But I think it's easy to chalk up as like line goes up, which is like one of the memes of today. But I think it is important to actually try to understand what's going on under the surface. And, you mentioned, first of all, tariffs. We just had Q2 earnings season. You did see meaningful tariff implications for a lot of companies, Caterpillar, a lot of the Detroit 3. You did see meaningful impacts from tariffs in the results in Q2. But I think more broadly, you also mentioned concentration. That really is sort of not the whole ball game, but it's a big part of the ball game right now, right? So I just looked this up this morning. If you take, April 8th, which was the bottom of the very rapid bear market we had post Liberation Day, if you take the stock market since then, from then to today, S&P is up about 30%, right?
Wow.
18% of that comes from 10 stocks in either the technology or the communication services sector.
So 60% contribution to total return.
Yes, that's right. That's right, from 10 companies. And look, I mean, they're almost all AI related, right? And look, who am I to say that AI is not going to be a transformational, that it's not going to continue to drive margins higher? That trend is alive and well, so that's part of it. I think it's important to understand though that even if you take the Mag 7 out of the market, the S&P 493 is still trading at above 20 times earnings.
Right.
That is well above where they've been historically, right? So I think there's something else going on. And, I think the reality is after Liberation Day, there hasn't necessarily been a strong enough catalyst to drive investors to the sidelines. Right. And I think as long as investors believe that this cycle is going to continue and that we're not going to go into some deeper downturn, there's not some urgency to sell stocks because, the mentality for 15 years has been buy the dip. Right. And I think that's kind of where we're at today.
But when you turn to private markets, I think this is where you see some of the concerns that we mentioned come through a little bit more. And we're always taught that public markets are much more efficient and more rapidly adjust to new information. Yet public market investing is so different than private market investing. And, I have to wonder if that's not affecting, the difference in activity. You see this, again, rampant optimism in public markets, but in private markets, we came into the year expecting a very robust merger and acquisition, boom and recovery. And there's a lot of capital on the sidelines ready to be put in motion and get that flywheel, as you always describe it, moving again. But it's been a little bit more tepid of a recovery. How would you kind of characterize how private markets are digesting the risks that are out there today?
Well, I like the way you framed it in the introduction, which was we came in expecting this really robust M&A market. That's not what we got. What we got was a continued gradual improvement in deal activity. But I think considering the backdrop and all that's happened in the first half of the year, it's pretty impressive, and I think speaks to a lot of the factors that have lined up behind a more robust deal environment, right? So you've got clearly strategics and financial buyers who there's demand, right, for these deals. There's the capital to supply these deals, right? There's a lot of the strategic rationale. These companies are performing well for the most part. So there's a lot of the components that you look for a deal activity upswing that are in place. And obviously, I think the reason you didn't get that was all the things we know, policy uncertainty. Sure. You've got the Fed has sort of had to be on hold because of the uncertainty around the inflationary impact of tariffs. But to your point, look, I mean, private markets are long-term focused, right? It takes a lot for a deal to get consummated. You have to understand a lot of things. You got to get the financing in place. In public markets, I'm not sure what the average hold time today is in public markets, but it's a lot shorter than it used to be. You've got retail, you've got momentum trading. The time horizon for an investment in public markets is just much, much shorter than it is in private markets. So I think the dynamics are different. And private markets have, I would argue, adjusted to the reality of the U.S. economy and where we are today in a much more connected way than the public markets have.
Yeah, I mean, I love the old saw, public markets are in the short term a voting machine and the long term accounting machine.
Sure.
Private markets are always a counting machine. You don't have the ability to be a short-term voter in private markets.
That's true. And I think this is probably a good time to dovetail into our defining trends that you sort of teased in the intro. And I think folks are probably chomping at the bit to get into, right? So why don't we kind of discuss some of our defining trends, which we've talked a lot about, the cyclical aspects, right? The deal upswing, or we didn't get it in the second half, we didn't get it in the first half. As these markets improve and we get into this new era that we're talking about, I think our belief is that there's going to be a fundamentally different way of investing in private markets, right? And I think that's really what we want to get into with these defining trends.
The first defining trend we cover is capital concentration, the limits of scale. And this is so important for private market investors. It's been, a couple decades of very solid, steady growth and size of these asset classes. And the managers of these asset classes have, paired off into different business models, different focuses in terms of parts of the market. But you've seen many at the upper end really grow in terms of their deployment capacity, the fundraising that they're bringing in. And so as the market has matured more so and kind of spread out into different strategies, we really address the question of whether there are limits to the benefits of scale. And you think about this in the context of an operating business. Scale is this great efficiency that you can have. You reduce your marginal costs. Production capacity increases. But in the asset management business, it's a little bit different. Certainly in terms of the operating company, there are benefits to be had in terms of scale, but in terms of the capital deployment, we really kind of put that question to the test. And it reminds me of something that was really sort of formative in my early years, of becoming interested in investing and in the markets and in the economy. I would watch Warren Buffett and Charlie Munger's, annual shareholder meeting discussions. And you'd learn everything about these businesses they were interested in, how to value companies, how to think about the economy. But one of the things that Warren would often talk about is that Berkshire couldn't do today at their current size what they did in their early years. And that was because they had so much capital at that point in time to deploy that there's not as many opportunities out there that can absorb that.
And you can't say no nearly as much.
Exactly. And so, when you're thinking about what are the limits of scale, I think, it goes back to what, Warren Buffett has described, which is that if scale grows faster than the opportunity, alpha degrades. The ability to get that excess return diminishes.
I think it's such an important point, because maybe we should step back and maybe put some numbers to this, right? Sure. Because to your point, as the private markets have grown, there's not only concentration in the public markets, we're actually starting to see concentration of a different kind in the private markets. And let me just give folks some numbers just to sort of
please
lay the landscape. So in the first half of 2025, if you look across all global private capital markets fundraising, 42% of capital raised went to funds that are $5 billion or larger, 42%, right? To give you some context, 10 years ago, that number was 15%. 5 years ago, that number was 23%. So it's doubled. The proportion going to what we call mega funds, right, which is just funds over $5 billion in size, has doubled in 5 years, right? To almost, we're close to half at this point, right? And that's even more acute in U.S. private equity, where it was 60% of fundraising in the first half of this year went to these mega funds, right? That's eight funds out of 137, raised 60% of the capital. So you have this incredible amount of pooling at the top end into these few strategies, right? And it's happening in private credit as well, where we can even extend that to $10 billion funds in private credit, where in 2024, we don't yet have this year's numbers yet for private credit, but $10 billion funds raised almost half of all the capital in 2024. And then in real estate, it's a little bit different, right? because, the real estate opportunity set is a little more dispersed. You can only buy buildings that are so big.
Sure.
But even there, $1 billion funds or larger raised 80% of the capital in the first half of this year. So it's occurring across asset classes, which means to me it's like a psychological thing, most likely. But I think as we dig into it, and to your point, this idea of the supply of deals and the demand for deals, there's growing competition here, and there's a somewhat structural scarcity of assets that you can buy.
Well, that was going to be my question: is if all this capital is concentrating in this part of the market, is the supply of deals in that part of the market keeping pace?
Yeah. I think let's take private equity, because I think that's where it's most acute, right? So in U.S. private equity, if you just look at how many mega funds are out there investing, right? So the way we sort of bluntly estimate that is how many mega funds have been raised in the past 5 years, right? Generally, a private equity fund will invest for its first, call it 4 to 5 years, and then it'll go into the harvesting stage. But over the past 5 years, there's been almost 60 mega funds raised that are investing today, right? 5 years ago, there were 30 mega funds investing. So the demand for these large deals has doubled, but the supply of them literally has not changed. in 2019, there were as many billion-dollar deals done in private equity as there are today, right? That's remarkable. You've got double the amount of capital chasing that, or maybe even more than double, and the supply of those deals just hasn't gone up. So, the question is like, what are managers doing, right? If the number of deals isn't rising, what they're doing is they're just trying to buy larger companies, right? So you're seeing the average deal that these funds are doing getting larger. In many cases, eclipsing $5 billion deals.
Sure.
And in many cases, like there are only so many companies that are that big, right? That are targets for private equity. So at this sort of largest end, right? Half of these are take privates. So you're just going to public markets and you're buying a company out and making it private. Now, can that work? Sure. But I mean, fundamentally, is that really the part of the private equity universe that you think is going to deliver the type of alpha that you're looking for in private markets? That's really the question. And I think as competition grows, it drives valuations up in this part of the market. And ultimately, I think, tell me if you disagree, but it risks eroding the types of alpha that you're looking for.
No, I think that's spot on. Something hit me as you were going through the number of mega funds raised. And, that's, and you
almost 60 in the past 5 years.
And so you mentioned, roughly 4,000 companies that are kind of the size that would be the target size for a mega fund to deploy into. So if you think about 60 mega funds, 5 billion or more raised over the past 5 years, and you assume, call it 15 to 20, deals per fund.
Seems reasonable. Plus add-ons, but yeah.
You're getting pretty close to where you're talking about needing to do deal volume that is 15, 20% of the market in terms of the total number of companies that are within that target segment. And that's with fundraising over the past 5 years. You roll that forward, if this concentration trend persists, now you're talking about you really will have to do acquisitions of 20% of the market, 30% of the market, even greater as you go forward.
And I mean, like you think about it, like, again, the number of companies that are of this size that are, good private equity targets, right? Like everybody knows who those companies are, right? Everyone, like, it's not like there's some secret company out there that's worth like $10 billion. Like, everybody knows who these companies are.
This is where the informational asymmetry of private markets begins to fade a little bit.
Yes.
Folks have good coverage of it. All the bankers know them. They're not hiding out there in the Midwest in a town of 20, 25,000 people. These are large.
Speaking from a Midwesterner, I'm sure. Yeah.
That's right. That's right. So what's this meant for returns? I mean, we're talking about a lot
That's
of
really
capital
matters, right?
going into small space. But again, like we want to bring this back to what's the impact of this?
Yeah.
Like, what do investors need to take away? What's happened with returns as a result of a lot of this concentration?
Yeah, and listeners, you can go to page 3 of our private markets outlook to see a summary of sort of how we're visualizing the impact to returns from this. I think it differs by asset class, right? In private equity, we've just seen a steady degradation in performance for the largest funds across vintages, right? So back in the early 2010s or mid 2010s, mega funds tended to perform okay. They provided less upside. Median returns were largely, in line with the rest of their vintage cohort. And then they also, chopped off your downside as well. Since then, that's drastically changed. Median returns for these large funds have gone far below their vintage peers. They offer much less upside potential. And they're also not protecting you on the downside, right? So you're seeing it most acutely in the private equity buyout space. In credit, it's a little bit different, right? Because credit's it's not about harvesting upside, it's about limiting downside. And I think in these large funds, you are seeing pricing tighten, but you're not seeing underwriting standards really degrade to the point where you'd be worried about meaningfully worse credit outcomes. So I think what you're just seeing is, smaller funds tend to have higher median returns, more upside in credit, but the downside aspect isn't quite there. So I think in credit, you can still make the argument that these larger funds have a place in your portfolio. And then in real estate, it's a bit of a clear trade-off where, smaller funds, they give you the opportunity to really outperform, but they also give you the opportunity to really underperform if you pick the wrong manager.
Picking up on what you described with private equity, one of the things that one could reasonably assume about what they view as a quality manager is, okay, I might forego some of the upside that I have. This isn't a strategy that's going to take excessive risk. It's going to be kind of regular way, down the fairway, private equity. But what you mentioned about the downside distribution not being as limited for the largest managers, in my mind, that really makes size and quality a bit of a conflation that folks might not traditionally think of.
Yeah, I mean, I mentioned, I think a lot of this is psychological, right? People see brand name, they see, wow, everybody else is committing to this fund. It must be safe, There's no career risk in allocating to these managers, generally speaking. Certainly not going to name names right now. Some of these managers do a great job. But speaking generally, I think there's a lot of that going on. There's this herd mentality. There's a lot of uncertainty in the investment world right now, and people want certainty. Our concern is that when everybody does that, it's sort of like a prisoner's dilemma thing. When everybody does that, you get this competition that drives up valuations and it erodes returns.
Sure. And there is an overlay between, quality and experience, we believe. I mean, that's a very important thing.
Experience in this type of market environment is really important, I think.
That's probably where the quality premium should be placed, over size is what we're arguing.
I would agree.
The mandate for private markets is to deliver alpha, and investors will need to dig beyond the surface level to find it going forward. Read the complete mid-year private markets outlook from Future Standard. Click the link in the description to download.
So shifting to the next defining trend, rate normalization, transforming the landscape. Very clearly this has an impetus for private credit, but we've been talking about private equity. I'd like to continue down that thread. I think this is one of the sections of the paper that I find most compelling. The insights, we have a lot of proprietary work within this section in terms of the data that we present and some of the visuals. I think it stands out. I mean, I would really emphasize for people to go and check out that section in particular. I want to tee it up a little bit. Why do we call it rate normalization instead of elevated rates?
Words matter, Alan. Okay, words matter. No,
I should take that to heart sitting here right now.
No, I think the easy answer is that, like, to me, when I hear elevated rates or even higher for longer, sometimes, which I still use, admittedly, because it's the the nomenclature in the market, but to me, it just sort of speaks to like this is a temporary thing that will likely revert to the mean, and to me, it just that just fundamentally misunderstands like what the mean is, right? To me, the sort of 2010 to 2021 era, was the 10-year in 2021 at one point, like 45 basis points. It was crazy.
Right.
Like you had an economy that was growing on a nominal basis, 4-ish% per year. And the 10-year was like, for a lot of that period in the ones or the twos. And the Fed was at zero. That's not normally how interest rates interact with what's going on with growth in the economy, right? Today, we've got an economy that's growing, it's real growth, we'll call it 1.5, inflation, call it 3, it's 4.5. The 10 years at 4.25, I mean, that's normal historically, right? And even if the Fed, and we may get a rate cut or two the rest of this year, even if the Fed cuts rates to call it 350 by mid next year, like a normal, yield curve is 100 to 150 basis points steep. You're between, 4.5, 5. Like, I mean, that's normal. That's a normal environment. So that's a long way of saying, like, to me, this is normal. Like what occurred in 2010 to 2021 and the sort of investment trends that it propagated was not the normal part.
So this has me thinking about go-forward returns for private equity. It's an asset class that employs a meaningful amount of leverage in the acquisition of companies. And it's a long-term, investment strategy. And again, it's a counting machine. A lot of that is discounting your cash flows over a period of time. Risk-free rates change. That changes the math. Andrew, could you walk us through, some of the ways that sticks out most prominently and that we highlight in the piece? Yeah,
and I think, it's helpful to kind of, decompose how folks underwrite private equity returns, right? So I think generally speaking, there's broadly seen like 3 levers you can pull. One is like you make the earnings of the company better. You operate it in a way such that like the revenues grow and the margins get better, right? That's simple. That's what we call an operational lever. Number 2, there's leverage, right? Which is like you put debt on the company and that increases the returns to equity. That is a financial lever. And then there's multiple expansion, right? Valuations. And to me, I think of that as like a hybrid of a financial and an operational lever because, on one side, you could have a situation where like a company is growing faster and as a result, it deserves to have a higher multiple, right? And that's more of the manager doing a good job than it is like some market phenomenon driven by lower rates. But there's also what happened in the 2010s, which was like interest rates remained super low for a really long time. There was a ton of liquidity pumped into the market, and everybody who bought a company was able to sell it at 3 times or 4 times higher than the multiple they bought it for, right? And so I would call that valuation beta, which is a lot of what you had in this, call it previous era up through 2021 or 2022. And, our view is pretty simple, right? It's like, we're not saying there's going to be no valuation expansion in this next era. It's just going to have to be earned, right? By operating the company in a really good way, optimizing its capital structure. There's just not going to be that beta aspect. And then, with leverage, higher interest costs detract from cash flows. It's kind of that simple. And it also limits the amount of leverage you can use and you can put on a company, right? So when we look at this, it's really going to have to be the operational levers, right? Improving a company's earnings, making accretive acquisitions, learning how to use AI, things like that. That's going to be the most prominent driver of returns going forward. And I think that is a change, at least for a lot of managers who are able to sort of use some financial engineering to improve returns.
Yeah. And when we think about how to drive that operating improvement, there's certain, like we talked about at the outset, when you're looking at a part of the market where, it's very concentrated in terms of the number of firms, they're all very large and prominent. Many have very well established and, competent management teams in place already. Then you compare to kind of down market, the U.S. middle market, where we see really strong growth still. We just got the latest numbers from the National Center for the Middle Market for Q2, and year-over-year revenue growth of near 11% in the U.S. middle market. And so it's this cohort of like 200,000 companies of enterprise value of 10 million to $1 billion in size. And this is where we see a much wider opportunity set. We see strong growth at the top line, and valuations there appear to be much more reasonably priced.
There's just more juice to squeeze out of these companies too, right? They haven't been necessarily professionalized by another private equity firm. They haven't been in the public market, certainly, where like they've been disciplined by public investors. And if like I said, if the operational levers are going to be what dominate, this is where talented operators can really add value, I think.
And if you're in an era where that multiple expansion is a little bit more challenging, it's not just a given that you're going to get 2 to 3x multiple expansion. What you can do, and we often see this in the market that we operate, if you kind of play that multiple game across like the sizes, with the multiple that a company that is worth 500 million is a lot different than the multiple that a company that's worth $1.5 billion is.
Yeah.
The problem is that there's not that much difference between $1.5 billion and $5 billion, or 5 to 10, unless it's an AI company. But down market, like that shift in size really matters. And so when you do have the strong operating growth, like you can kind of capitalize still on some of that multiple expansion, that you see that you've seen historically.
Absolutely, no, it's a great point. And I would also, before we move on, the same dynamics play in real estate as well, right? In real estate, you saw 500 basis points of return per annum just from cap rates coming down and prices going up, right? That doesn't mean prices won't go up at all in this next era, but it's really going to be an income-driven story in real estate, similarly to private equity, I think. And I think that has big implications for how investors are approaching the real estate space relative to the past, call it 15 years.
And of course, one of the reasons why private equity in particular has been a little bit more challenged with the rate normalization environment is because private credit, the primary source of financing for
borrowers pain, lenders gain, right?
Yeah, the primary source of financing for LBO transactions are getting paid more before the cash flows get down to the equity holder. And this creates additional opportunity within private credit. We also see a broadening out of strategies within private credit. But in general, what are your high-level views on the market and where it sits today?
I mean, I think sometimes we overthink things. I think, look, we were in a negative real interest rate environment for a while there. Now we're in a positive real interest rate environment. Like, that makes credit more attractive, I think. It makes income-based products more attractive. I think that's the simple kind of headline story. I mean, right now you've got about 10%, nominal yields on regular way senior direct lending. You call it 3% on inflation, whatever it is. And you've got a 7% real return starting point, right? Like, now you may have some credit losses, but like that's a really compelling real return, starting point right there. That's on par with what you might expect long term from your equity bucket, especially at these valuations, right? So I think credit becomes more attractive in this type of environment, and from a portfolio construction standpoint, maybe you should allocate more there. We're not giving financial advice, of course. But I think there's also the other side of it, right? Which is like there's no free lunch. Like you can't go make 20% yields and expect not to be taking a little bit more risk.
Sure.
So I think from a borrower standpoint, there's less room for error when you're borrowing at these interest rates, right? So what that ultimately means to me is it doesn't necessarily mean that default rates are set to skyrocket, but what it does mean is like credit underwriting is really going to matter, right? And having a differentiated underwriting process is going to matter. So when we get to these periods where defaults maybe do start to tick up, you're going to start to see who really picked the right credits and who didn't. So I think that's a long way of saying, number one, I think credit becomes fundamentally more attractive in a higher rate environment, rate normalized environment, excuse me. And number two, there's going to be wider dispersion between credit managers.
And something else that we're seeing this year to date is the kind of widening of the outperformance of private credit relative to syndicated credit. And it really highlights some of the differences, in my opinion, in terms of structuring within the market, the underwriting capabilities, because you've seen really for the first time ever, this just gapping out of the difference in default rates in the syndicated market versus the private credit market.
Yeah, I mean, originating for your own balance sheet is very different than originating for somebody else's balance sheet.
Yeah, and so when you're in a backdrop of like the economy slowing a little bit to where maybe the upside is slightly less compelling, but you're still kind of on firm footing like what we've talked about, that's a great environment to be a credit investor.
Yeah.
Especially if we start to get the private market deal flywheel churning a little bit more and get a little bit more new supply to the market to kind of break up some of the spread tightness that we've had this year.
Agreed.
That's a really terrific environment, again, with a starting point, if you consider your expected credit losses and inflation, of real returns commensurate with long-term equity performance.
Absolutely.
So we'll move to our last defining trend. We covered capital concentration, the limits of scale, rate normalization, transforming the landscape. And now we want to talk briefly about geopolitical and policy volatility, investing through uncertainty. We talk a lot about this. We've written a lot about this. I think folks that have followed our research content know that we've spent a lot of time dissecting the tariff policies, trade policies, the related impacts. I think we can get through this, pretty succinctly, which is to say, that is the foremost crux of the issue right now.
I mean, absolutely. And I think we have a line in the report where we say, I think the first half was an exaggerated version of what's to come. Certainly, we're not saying there's going to be this level of like disruption and policy volatility and uncertainty, like, into perpetuity. But I think we are seeing, right, like geopolitical competition, particularly between the US and China, particularly on AI, is really rising, right? You're starting to see strains in relationship with certain other countries. Obviously, trade policy, the sort of free trade consensus is being interrupted. You're seeing all of these changes that ultimately kind of, to me, lead to like, if not deglobalization, then like stagglobalization, right? And like this is a fundamental transformation in the investment landscape, I think. So, I think what does it mean? It's really going to be from a sector by sector, asset by asset basis. And it's just going to add more complexity to me into underwriting. But it's also going to introduce new opportunities as well, I think. Right.
And I want to pick up on this through line about the shift from global cooperation to competition. Like, to me, this gets at the heart of why we're having the geopolitical and policy volatility that we are, is because we're now living in a new world where that's the dynamic with your neighbors, friends, allies, and certainly with your rivals. And we're combining that with an era where we have generational technological improvement, and there's an arms race in many respects in AI, in robotics, to be the global leader, because it is viewed as an existential, problem that we must establish leadership in this area, which breeds focus on natural resources and production inputs things that have elements of scarcity. And if you don't have these vital inputs to take that next leg of growth in these key technologies and growing areas, you risk getting left behind, and you have to kind of go out and find those resources elsewhere.
Yeah.
That like zero-sum game in terms of who can kind of lead that next wave of growth and next, preeminence throughout the world, when it's got that natural resource kind of scarcity element to it.
Yeah. No, I think it's a really good point. And, if we want to kind of apply that, like, I think, in private equity, certainly, like, you look at, to me, you're certainly not seeing it in the Mag 7, but like, this is going to be a challenge for companies who've been able to expand margins either by selling abroad or by moving operations abroad, right? Clearly, this administration is targeting, international supply chains. That doesn't mean every company is going to be negatively impacted, but certainly I think I'd rather be a company that's domestically focused right now than one that's really expanded globally. I think in private credit, like, it introduces another variable into the underwriting process, right? Like, this is something you didn't really have to worry about previously. And again, credit's all about protecting on the downside, right? So it just adds another risk, and it adds another, capability that you're going to need on your credit team to really understand what's going on. Or, you can sort of focus on maybe the lower middle market where most of these companies are largely domestically focused and don't really have to worry about that type of thing. And then in real estate, these are physical assets. That's not to say that, like, they don't get impacted by knock-on effects by what goes on in the macro. But largely, there's certainly some issues from trade that go into industrial or retail. But by and large, these are physical assets that are located in the United States. So, from an asset class perspective, real estate is relatively more insulated from these types of effects than maybe some other parts of the market.
Sure. So, Andrew, I've loved this discussion. It was a blast to work on the piece itself and dive into so many different areas and really challenge, the thesis that we have as a firm, in so many different areas of the market, and put that to the test and, present that for our investors. And we really want to center on that as we close out the podcast here. And, before we do, I want to mention, this is the first podcast in a series that we'll do focused on the private markets outlook. We'll bring on, special guests from around the firm, some of our portfolio managers in the private equity, private credit, real estate parts of the market, and then hopefully a very special guest to present on, the new imperative. But to tee up that, that concept for us, this is really the through line of the paper. What is the new private markets imperative?
Yeah, I think we wanted to create some urgency, and first of all, thank you for your all of your awesome work on the report as well. Really happy with how it came out, and hopefully our listeners give it a read and agree with that. But here's how I would sort of wrap this up, right? I think there are sort of two imperatives right now that sort of fall out of each other. The first one is, to me, over the past 15 years or so, private markets have been sort of a nice to have, right? Like, in many cases, they would have enhanced portfolio performance, they would have enhanced portfolio outcomes. But like, U.S. equities did so well, and bonds diversified them so well that like you could still like clip like an 8.5% annualized return with like very low inflation. That's pretty good with a 60-40. So you could have done pretty well. I think over the next 15 years, given the issues we've talked about with like, we're trading at 23 times in the S&P 500, right? The concentration risks, should AI not pan out or should something happen, right? And then, we haven't talked about correlations, but over the past 5 years, there's a meaningfully positive correlation between stocks and bonds. So there's real challenges that didn't exist 15 years ago, right? So I think private markets investing has turned from a nice to have to sort of a need to have for portfolios. And then that sort of brings up the second imperative, right? And that's essentially this, that investors are going to need to dig deeper into these markets to source differentiated returns, right? So think about what we've just discussed. There's growing competition in the segments of the market where many investors are currently allocating, right? Normalized or higher interest rates raise the bar for what constitutes a successful investment, and they blunt the ability for managers to use financial engineering to drive return. And as we just talked about, the backsliding of globalization is a massive deal that's going to complicate underwriting and introduce some new risks, right? So look, these are all major shifts that we've just gone through. Hopefully we've, convinced folks that in this sort of next leg of private markets investing that you're going to have to approach things differently. And, we're going to get into each, in depth into the implications within each asset class, as you mentioned, with some of our portfolio managers from around the firm that I'm really excited about. So this is just the first of 5 episodes. Thanks for having this discussion, Alan.
Well, this will be a fun journey, and can't wait to continue.
Absolutely. Cheers.